Let's start with that inflation projection. Upward revisions to our inflation projections. On what?
Well, what we learned this week is, with the results of the election, is that we will likely have an increase in tariffs next year, and we will likely have restrictions on immigration. And this is regardless of the outcome in the House of Representatives. So we think that with the tariffs, we are likely going to see an increase in prices, in the price level, that will increase inflation. We think already in 2025. We estimate that the tariffs could increase inflation by a good 0.5 percentage point next year. And then that might have some lingering effect in 2026. On top of that, restriction in immigration are going to, in our view, contribute to a tighter labor market. And with a tighter labor market, we are likely going to see a little bit more wage pressures by the end of next year. So all of that has contributed to raising our inflation forecast by about 0.4% next year and a little more in 2020.
So 2 points, tariffs and immigration.
Correct.
What are your working assumptions of what the tariffs will be, one, and what kind of immigration policies you expect to see?
So President-elect Trump has talked about imposing tariffs like 10% across the board, maybe 60% on China. We didn't take this full on board because we think that there's likely going to be some negotiation between the US administration and other countries. So we basically took half of that effect, roughly. And so we think there's a lot of uncertainty around the magnitude of these tariffs. But in any case, this is what we started with as an operating assumption. And then with that, we think that that would contribute to roughly half of the effect that we would expect under the full 10%, 60% on China tariff imposition. So with this, we expect that that would contribute to roughly 0.5 percentage point on the price level, which would translate to about 0.4% next year's inflation, about 0.1%, 0.2% in 2026 inflation. And then on the immigration part, we think that President-elect Trump would impose tighter restrictions that the Biden administration has already imposed with the executive action starting in June. We think that that would lower the flow of immigration further. The assumptions that we make here is that we would return to something close to the flows of immigration we've seen under Trump 1, basically in 2017, 2018.
So going back to tariffs, is the big charge from tariffs the cost that gets implemented either on the producer or the consumer, or is it that it has to be made somewhere else, and that somewhere else has to be the United States at a time where you've got a tight labor market, reduced flow of immigration, and maybe not even the expertise in certain types of production?
Right. No, exactly. So it's all of the above. So there's a direct effect from increasing the price of imports. And then there's a little bit of an offset for an appreciation of the US dollar, potentially, that could undo some of these. But then, to your point, then you need to produce the goods domestically. And so you need resources to produce these goods domestically. So that would raise the price on other goods and services domestically as well. I mean, there are a lot of effects going back and forth, but the primary effect is basically the higher import prices, and then maybe some more internally that would raise all of them.
Marc, if they're going to be made in America, though, the former president, future president, is talking about a 15% corporate tax rate. Correct. Can that help bleed into potentially offsetting the increase you would see from tariff proposals, maybe decreasing the price of goods?
So I think longer term, potentially. But I think in the short run, you need to produce the production capacity and construct the plants and all that in order to have a bigger production capacity. And you need the workers to produce all of that output that's now required to be produced in the US. And if you put tariffs at the same time as you limit immigration flows, it's not clear where the workers are coming from. If we had a 10% unemployment rate at this point, I would say there's a lot of slack in the labor market. You can, of course, absorb a lot of the workers to produce that. But with an unemployment rate at close to 4%, basically with the labor market at full employment, and a population that's aging, and all the workers basically not really returning to the labor market, it's not clear at all who is going to be producing that increased output.
So this week you changed your forecast. This week we didn't get new Fed forecasts. They were asked about their old forecasts and Chairman Powell ummed and ahed. We get some new forecasts in December.
Correct.
How stale will those forecasts be in December? Because they're not going to take account for any of this until when?
Yeah, so Chairman Powell was asked a lot of these questions yesterday, and he said basically we're in the middle of that cycle here, and so it sounds like So far, even absent any of the Trump policies put in place next year, even absent all of these news, we've already seen very resilient labor market in September. We've seen upward revision to the GDP, national income accounts. We've seen firmer than expected inflation prints. All of that would suggest that basically the unemployment rate, if anything, is going to end up the year lower than the Fed had expected back in September, that activity is going to be slightly stronger, that inflation is going to be slightly more elevated. This is absent any of the new policies that might come in next year. On top of that, I think for next year, we can anticipate, as I argued in our forecast, like higher inflation and more activity and potentially a tighter labor market. So I think that implies that the rate path overall is going to be, will have to be slightly higher than what the Fed had penciled in.
So I wonder, especially since Jay Powell was talking about inflation as a new concern that they're putting on par with employment, I'm wondering how high the bar is for next week's CPI report to potentially torpedo the chance of a December rate cut.
I think basically the FOMC meeting yesterday with the statement and the press conference have basically left all the options open at the December meeting. Our baseline is still for the Fed to go with a 25 basis point cut, because and Chair Powell repeated yesterday that they see policy as being still restrictive. They think they want to go to a more neutral level of interest rate. And so we think that they really want to cut rates. But I think it's going to be a close call. And in particular, if the inflation print next week come in firmer than expected, we expect something around 0.3% for core CPI next week. That's going to be higher than what they had, presumably what they had anticipated at the September meeting. And then we'll have another CPI just before the December meeting. And we'll have also an important payroll report in November, in the November payroll report in early December. That one is going to be particularly important because it's going to tell us something about the underlying pace of job gains. Remember that the last month's print was particularly noisy due to the hurricanes and all that. We expect like a very big rebound in the payroll print.
What's a big rebound, just quickly? What kind of number?
Well, we think the underlying pace of job gains is around 150,000 a month. With the 10,000 job gains in October, we think we could have easily a print of like 250, 300 in early December, if indeed this underlying pace is around 150. So the picture of the economy when you sit down at the FOMC meeting in mid-December is going to be very different than the one that they've anticipated.
I've got to say, that doesn't sound like a rate cut in December.
That's what I was going to say.
That sounds like a pause, Marc. It's good to see you. It's good to catch up. Appreciate your new forecast. It's good to look through. Marc Giannoni there of Barclays.